How's it going today, guys? So today I thought it would be good to make a video talking about mutual funds, and I just wanted to mention before this video, there's a number of videos on YouTube about mutual funds that are, I'm going to be honest, they're pretty good. But the one thing that I've noticed that they don't do is they don't really lay out the pros and cons of mutual funds. So after I go over explaining the basics of a mutual fund, I'm going to go through the pros and cons list of them. Now here's the reason why most of the videos on YouTube do not do this, and that's because most of the videos about mutual funds are made by people who sell mutual funds. So by some company that sells mutual funds, or somebody who has a financial interest involved in mutual funds. So for me, I don't gain anything by selling you guys on mutual funds. So I can be honest with you guys. Whereas some other companies posting videos, they want you to buy mutual funds, so they're going to lay them out in a very positive way, and they won't really talk about the cons with the mutual funds. So I'm going to be doing that for you, and I think that will kind of add more value for you to have that perspective. But a mutual fund is basically a pool of funds invested in securities such as stocks, bonds, and money markets. And generally speaking, it's a blend of those things. So if you can picture many people giving their money into a collective pool, and then there's investors who basically are very skilled at investing, and they diversify that money across different stocks and bonds and money markets. So that's what I said here. It's operated by money managers who invest the fund's capital, attempting to produce income or capital gains. So obviously the idea with a mutual fund is to have your fund grow over time, so your investors make capital gains, and they're very happy, and they stick with the fund, and then they give the people their money, and then they're making their money off their commission, so everyone's happy. So the idea there is that you're making money in the process of doing this. So the portfolio of a mutual fund is structured to match investment objectives. So there are different risks as far as mutual funds go. There's some people who have a higher tolerance for risk and a lower tolerance, and that may also be due to the fact of how close you are to retirement and how much you want to be risking your money versus having more money in bonds, so that way that it's more of a surefire bet than it is betting in stocks or investing in stocks. So there are different mutual funds to suit your risk tolerance, and there's also funds that have different investment objectives. So the portfolio is kind of structured by the investors of the fund, the people who basically structure it around those different objectives based on whatever it is that you're looking for in your investment. So the mutual fund performance is tracked by total fund market cap, and this is derived from clustering the performance of the underlying investments. So because you're investing in so many different stocks and bonds, the performance of each is different on any given day. So what they do is they have to pretty much combine all those together and see if the losses are outweighing the gains, or however that's doing, to determine how the fund in general is doing. Now that's actually considered the NAV, or the net asset value of the fund. So that's kind of like similar to saying, oh, this is the share price of a stock. The net asset value of a mutual fund is basically the total value of the securities divided by the outstanding shares. So that's basically how the fund is performing in general. With all those different, stocks and bonds and money markets collectively, how they're all performing. So there's three types of fees that are generally associated with a mutual fund. You have your advisory fees, your management fees, and then any administrative costs. And we're going to get into the pros and cons of mutual funds after I go through this, but that's one of the cons of these, is there's a lot of fees involved with mutual funds that you wouldn't see in other investment types. So there's a number of different ways that they'll structure the fees with a mutual fund. There's a front-end load, which is where the fees are assessed at the time of purchase of the mutual fund. There's a back-end load, where fees are assessed when the investor sells the shares. And then there are some no-load mutual funds. Personally, I haven't come across them, but this is where there's no commission or sales charge. This is because the mutual fund is sold directly by an investment company, not through a second party. Like I said, I'm not super familiar with that one, but this was just pretty much a lot of the information I saw people talking about. I wanted to kind of collectively pull it together. So if you're more curious about a no-load mutual fund. I'm sure you can do your own research, but this is just kind of an overview video, so I'm not going to go crazy in depth about that. Alright, so here are the pros and cons of mutual funds. These are pretty much the main ones that I saw through the research I was doing. And I'll kind of explain those to you because some of them kind of need a little explanation. The pros we'll do first. So the main reason people like mutual funds is because they're highly diversified. As you know, any investor knows this, you don't want to have all of your eggs in one basket. So you don't want to be investing only in one sector, because if that sector performs badly, your whole portfolio goes down with it. So you want to be diversified across many different sectors and to be involved in many different stocks and markets. So when you're more highly diversified, there's going to be a lower risk because the odds of all of those sectors performing badly, that's very uncommon. So generally speaking, if one sector is performing poorly, another one's doing better, and they tend to offset each other. That's the idea with being diversified. The other pro with this is there's a high demand for most mutual funds, which means they're easy to sell. A lot of people don't consider this with an investment, but when you're buying a stock or whatever it is you're buying, you want to make sure there's a buyer for you when you're waiting to sell. There are some cases where you could buy a small cap stock or some kind of OTC, over-the-counter traded stock, and probably with day trading too, you can run into that as well if you buy, well, not day trading, but if you're buying penny stocks, very low, low trading price stocks, there may not necessarily be a buyer for that stock when you're waiting to sell. So that's something to consider. You definitely want to be able to liquidate when you want to. You don't want to be waiting for the buyer to come along. So because there is a high demand for these, they're pretty easy to sell. They're a very passive investment. For somebody who doesn't want to be thinking about their investments on a day-to-day basis, they're great for you because you set it and you forget it. The idea is the fund is being managed and it's all being taken care of for you behind the scenes. And that's the good thing too with this, is it does allow people who may not have as much money to have professional management of the fund, because management of your finances is very expensive, but when you collectively pool your money, it makes it so that way people with less money can have professional management of their finances, which is another advantage that kind of falls into this passive investment pro on the list here. And then the other pro is there's generally easy comparison between the different mutual funds. So those are the reasons a lot of people generally like them. Now here's the cons with mutual funds. And like I said, I didn't see anybody else on YouTube talking about this because I think most of the people making videos about mutual funds were trying to sell them. So they wouldn't want to tell you about the cons of them. But this is the cons of mutual funds. Because of these people that are managing the funds for you, they get to be kind of expensive. Some of them do, with the advisory fees and the management fees. So they are a more expensive investment as far as commission goes, and the different fees you're paying out on them, and that can eat into your profits. The other problem, or the other con with these, is that the index may actually outperform the investment, in which case you're paying those managers to do nothing, because you could have just invested in the index as a whole and it outperformed the actual mutual fund, which was being managed at that point. So you're paying a commission and you didn't even outperform the index. So that's another con. And that could happen in any mutual fund, really. It's not specific to anyone, but it's just something to consider. The other issue with these is if you're looking for a higher risk mutual fund, in some cases you're going to be paying more in advisory fees because that requires more management and more human involvement in that fund, because there may be more trading on a daily basis. So you may be paying the people who are managing the fund, you may be paying them more money because they're more involved in that investment. The other problem or con with this, and this isn't a huge deal, because for the most part, when you're buying a mutual fund, it's a long-term investment. You're not trying to buy a mutual fund and sell it 3 weeks later. Well, you shouldn't be. So if that's what you were thinking, don't buy a mutual fund. This is something you buy and you sell many, many, many years down the road. So another thing to point out here too, you don't want to tie up money in a mutual fund that you're going to need within the next, I'll say, 5 years. It's money that you want to set aside. You want to leave it to grow over many years. You don't want to be putting money in there that you're going to need 6 months later to buy a car. Just find something else to do it, or honestly, just keep it in liquidity. It's not worth it to do anything with that for the most part. But this is the issue. There's no intraday trading with a mutual fund. That's because, like we talked about before, that net asset value, they have to settle that at the end of the trading day. So once they've determined, the stock price for all those different, or the market price for all those stocks and bonds, or the money markets that mutual fund has, they settle the value for the mutual fund by seeing, how the fund performed as a whole. So you can't sell midday. If you were to sell a mutual fund during that day, it would sell for whatever that net asset value settled for at the end of the day. So you can't trade any kind of, if there's like a midday spike in the fund, or if there was a midday spike in a lot of the stocks involved in that, you couldn't take advantage of that. You would be selling for whatever it all settled for at the end of the day, basically. And like I said, I don't think that's a huge con, because most people aren't, day trading mutual funds. Nobody day trades mutual funds. You're selling them, based on how the market's doing over a long span of time, generally. The other thing is, and I don't know a ton about this, I'm not going to lie, I just threw it up there because a lot of people mention this, they're not the most tax efficient investment. And this is just an overview video. I'm not going to go crazy in depth with this. If you want to do your own research, I'm sure there's a lot of different resources that can explain that better. But there are some investments that have like tax loss harvesting and different ways that you're kind of avoiding paying so much in taxes. And you do pay, your capital gains tax on whatever you're making on the fund. So it isn't the most tax efficient investment, I'll put it that way. And if you want to learn more about that, just do a Google search on that. I'm sure you can find some information on that. And this is an interesting point too, because I actually didn't realize this until I did my own research. But if they're, the herd investors are basically, doing whatever the market is doing. So when the market is down, they're selling, and when it's up, they're buying. They're basically doing the exact opposite of what they should be doing. And the problem with this is these herd investors, these inexperienced investors, you're not one of them, because you're watching these videos, you're learning and you're being educated. But for those of you out there, for the people who aren't watching these videos, they may be the herd investors, and they're going to end up, selling out of panic when the market goes down. So here's the problem. Because the mutual fund is a combination of many different stocks and bonds, if you had somebody sell in a down market or in a bear market, the fund is going to have to liquidate money to pay that person off. So at that point, you're forcing basically the whole fund to sell at that point there. So when you really should be holding and waiting for that market to come back up, the people who sell will force the fund to liquidate assets in order to pay that person off, because that money is invested. They don't just have liquidity sitting around, so they have to free up some assets in order to pay that person off. So that is one way that other investors could pull you down in a mutual fund, and it's something you should consider if you're getting into them. But I mean, how much is it really affecting the fund as a whole? Yeah, that all depends. Probably not a ton, but it is something to consider. Personally, I do have a mutual fund. It's with Franklin Templeton. They seem pretty good. I mean, I'm not sure. I didn't really go crazy into the fee structures. I have a family member who's involved in financial planning, so they set me up with that. But if you are looking at different funds, look at those fees especially and see what each one is charging you, and figure out what the investment objectives are of the fund, and find something that you're comfortable with. Personally, most of the trading I do these days is actually individual stocks. I don't like the passive investments. I want to kind of be more involved in my investments. And because I make videos about trading stocks, I kind of like to learn stuff myself by doing and share with you guys. So if you guys are at all interested in my own stock market trading strategy, I just finished my ebook I've been working on for the past 3 months, and I will link up to that in the description, because I've actually had pretty good luck just trading individual stocks using technical stock analysis to figure out when to buy and sell my stocks, and I've had pretty good luck with it. So if that's something you're interested in, I will link that up in the description. But that's pretty much all I got on this video about mutual funds. If you guys have any questions, drop them in the comments. I'll be sure to answer them, and thank you guys for watching.